This video is designed to help Year 12 accounting students know and understand how to record product costs in inventory cards, in the general journal, and in the general ledger. First of all, what are product costs? So product costs, I've got the definition here, and I've broken it down into the two key components. So a product cost is any cost that is incurred in order to bring inventory into a condition and location ready for sale that can be allocated to individual units of inventory on a logical basis. So those that have watched the video about calculating the cost of inventory will be familiar with the part in purple, condition and location ready for sale. What this means is about costs in getting the inventory to our business. So delivery in and delivery to the business would be two examples. Okay, delivery in or delivery to the business is how it might be phrased. It is not about delivery to the customer. That's because that occurs after the sale. So things that occur before the sale. We could also include things like costs to modify or change the item. So an example would be if we get some inventory and we add our own logo to it before we sell it. That would be an example of a modification. So those things are changing the location. So this one here is changing location and this one here is changing condition. Now, what makes it a product cost is the second part in blue. It can be allocated to individual units on a logical basis. So what this means is that costs can be assigned to a particular item. So it might, for example, cost us $2 per item to add a logo. We can attribute it to individual items and we can allocate it logically. You'll be able to see some examples of what it means when it can't be allocated logically when we talk about period costs. So let's look at an example. We've got 3 examples to go through. Now, each of these examples have been taken from the Cambridge VCE accounting textbook. So what we've got here is on the 15th of April, McAvoy Golf Gear purchased 15 golf bags from Bear Industries. The invoice showed us the following. So we had the price of the golf bags and we had cartage in. We then had some GST on there. Now, the cost price, remember, is about getting items into our business and also about getting them into the condition ready for sale. So cartage in would become part of the cost price. So if we have a look here, we can see that each of the bags cost us $190. So cost price per bag equals $190. And because we had cartage in, that's about getting the item into the location ready for sale. Now we can see that it had $150 in total. Now, can we logically allocate that to individual items of stock? Yes, because we only got the golf bags. We got 15 of them. So if I divide this by 15, that will give me the amount of cartage it cost per golf bag. So I would do 150 divided by 15 equals 10. So my cost price per bag would be $190 plus $10, which is my $200. Now you can see that I've then recorded that down in my inventory card. So invoice 361, 15 items, and instead of showing them at the 190, I'm recording them with a cost price of $200. So what that means is that the cost price equals the item plus product costs. That's how I get the $200. And you can see there that this business is obviously applying FIFO and they are recording the balances according to when they came into the business here. So what does this look like over in the general journal? Well, similar to any other credit purchase of inventory, we would have the asset going up for inventory. Because we are paying GST, we would often treat that as the liability going down. And our account payable to Bear Industries, so the amount that we owe them, is going up. And you can see that this then translates down into our inventory account, our GST clearing account, and our account payable account. So this is a basic example of how to record product costs. Example 2 is where you record product costs, but when the product cost comes from a different supplier perhaps. So you can see here we've got 15 golf bags again, same transaction. They cost $190, but you can see that the delivery, so that cartage in to the business of $150, was done by a different company. And you can see it's even got a different source document. So we've got invoice 51 for the golf bags and check 52 for the delivery. So the same philosophy applies. Because that delivery or that cartage in is to get the items, the golf bags, into the location ready for sale, it becomes part of the cost price. So you can see that cost price is still $200, same as in the first example. And you can see that the only difference is in the inventory card, the source documents that are given here. We are referencing two source documents. This one here is for the bags, and this one here is for the delivery. Over in my general journal, you can see there's a little bit of a difference here as well. You can see that there are two transactions on the 15th of April. First one is for the bags, second one is for the delivery. Notice how the first one for the bags is the asset going up, the liability going down, and the liability of account payable going up, the same as the first example. And in the second one, we've got the asset going up by $150, and that represents the amount that we've now included as a product cost. We still have some GST attached to the delivery here. And you can see that they've referenced bank. And the reason why they've referenced bank is because we had a different source document and it was check 52. So just something to be careful of here is that it's going to be separated into some different transactions because of the two different source documents. So example 3 is how to record product costs on same dates versus different dates. So you can see I've used this here is the same as example 2, where we've got purchase of golf bags and then we've got a different company delivering it. On the right hand side, we've got the same concept where we've purchased the golf bags from McAvoy Golf Gear and Green Square Delivery has delivered them to us, but the delivery occurs on a different day. So have a look at the two inventory cards. And what you might want to do is pause here and think about what's different between these two inventory cards and how have they recorded these product costs from different suppliers on different dates. Hopefully what you'll be able to see is that when it occurs on the same date, it can go into the one transaction. So one transaction on the 15th with two source document references in the details. So these are our two source documents. When it happens on two different dates, we have two different entries into the inventory card. And look what they've done here. They've recorded the invoice for the golf bags, and they've recorded the check for the delivery. But when it comes to the balance, instead of having 1510, they've actually just adjusted the balance. So the balance has gone from 190 and now it is at 200, where they're recognizing the product cost. The reason why it's important to do this is otherwise you might think that all of a sudden you've got some really cheap $10 golf bags in here. That's not what happened. We're simply adding the product cost onto the cost price of the golf bags. So these are 3 different examples of how to handle product costs. It's important to read any scenario you get carefully because it can change how you record these different items in our inventory cards, in our journal, and in our ledgers as well.